I wasn't going to make this video. I was literally sitting here going through my watch list, checking dealer quotes, doing that thing where you tell yourself you'll step away from the charts for a few hours. And then I saw it again. Another post, another comment, another person asking when the big squeeze is finally going to happen. And it hit me. We're almost 2 months into 2026, and a lot of people are still holding positions based on a story that already ran its course and left a different lesson than the one that got advertised. And that frustrates me because I think you deserve the truth, not the opium. So here it is. Saturday, February 19th, 2026, Denver time. Comment what day and date you're watching from, because this story moves in real time, and I want to know where you are in the cycle when you hit play. And real quick, if you value calm, numbers first breakdowns like this, support the channel by subscribing and commenting FinTalk OG so I know you're here for the real work. Now here's the claim making the rounds for the last year. The silver squeeze was inevitable. Physical demand was going to overwhelm the paper markets. COMEX registered inventory was dangerously low. Open interest was sky high. Reddit was mobilizing. Retail was waking up. The big shorts were trapped, and any day now, the whole system was going to snap. Premiums were going to explode to $50 over spot. Silver was going to rocket past $150 and never look back. Delivery failures were going to dominate the headlines, and if you just held on and didn't sell, you were going to retire early. And on the surface, it sounded airtight. The data looked compelling. The charts looked ready. The sentiment was electric. But when you slow it down piece by piece, you realize the squeeze didn't fail because the thesis was entirely wrong. It failed because the thesis was incomplete. It confused a real supply side story with a financial market guarantee. And the difference between those two things is everything. So I'm going to break down 3 things for you. First, what actually happened with the squeeze narrative and why it didn't play out the way the loudest voices promised. Second, what we learned about how silver actually moves in the real world, not in theory, and what the real pressure points are that matter. And third, how to think about silver for the rest of 2026 now that we're past the hype phase and into the prove it phase. This is going to be practical. This is going to be honest. And if you're holding silver or thinking about buying, you need a framework that survives contact with reality. Now, before we get into what went wrong, let me say something clearly to people who believe the squeeze story. Don't let anyone shame you. A lot of smart people thought it was plausible. The fundamentals were real. The setup had historical echoes. The problem wasn't that you paid attention. The problem was the story got simplified into a guaranteed outcome, and anyone who questioned the timing or the mechanism got shouted down as a shill or a paper hands trader. And that's not how you build a thesis. That's how you build an echo chamber. If you bought silver at 110 or 115 or 120 based on that narrative and you're sitting here frustrated, that's not stupidity. That's tuition. And the only question that matters now is what you learn from it and what you do next. So let's start with what we can verify. The squeeze narrative peaked in late 2025 and early January 2026. Silver ran from the low 30s in mid-2025 to a high of around $121 per ounce in late January 2026. That is not a typo. That is a generational move. And it was driven by a combination of real factors. Registered COMEX inventory had dropped to levels that looked historically tight. Recent publicly available data showed registered metal hovering just under 100 million ounces. Open interest in the March contract was elevated, with hundreds of millions of ounces in paper claims outstanding. Delivery notices started climbing. Physical premiums on certain bullion products spiked into double digits over spot. Coin dealers reported back orders. Mints struggled to keep up with demand. And the narrative wrote itself. If everyone who held a contract stood for delivery, the system couldn't possibly handle it. There was more paper silver than physical silver available. And when that imbalance gets exposed, price goes vertical. That was the pitch. And for a few weeks, it looked like it was playing out exactly as planned. And then January 30th happened. Silver collapsed. Not a correction, a collapse. In one session, silver dropped from over $110 to the mid-70s. Some exchanges saw prints as low as $75. Billions of dollars in value evaporated in hours. Leveraged longs got liquidated. Margin calls cascaded. Volatility went parabolic. And the question that everyone is still asking is how? If the fundamentals were that tight, if the squeeze was that real, how did price fall that hard that fast? And that's the question we need to answer, because the answer tells you what actually moves silver. Here's the clean way to think about it. The squeeze thesis rested on three legs. Leg 1, physical demand overwhelming supply. Leg 2, paper market unable to deliver. Leg 3, forced short covering, creating a feedback loop that drives price into a blow-off top. What actually happened is this. Leg 1 was real, but it's a slow burn, not a light switch. Leg 2 was real, but not as fragile as advertised. And Leg 3 never triggered because the conditions required for panic covering didn't materialize. Let me walk through each one. Leg 1. Physical demand. This part is not made up. Industrial demand for silver is strong and growing. According to recent energy forecasts and government reports, solar panel buildout is projected to add over 20 gigawatts of new utility-scale capacity in 2026. Each gigawatt requires silver for photovoltaic cells. Data centers, the backbone of AI infrastructure, are consuming more silver for connectors, switches, and thermal management. Electric vehicles use more silver per unit than traditional cars. And yes, investment demand spiked. Coin sales from major mints hit multi-year highs in late 2025 and early 2026. Dealer premiums widened. Regional tightness in India, parts of Europe, and pockets of North America was real. But here's what the squeeze story missed. Physical demand is a flow. It's not a shock. It accumulates over time. Even when the U.S. Mint reports a record month, that's measured in a few million ounces, not hundreds of millions. Global silver mine production is around 800 to 900 million ounces per year, with total supply when you include recycling pushing over 1 billion ounces. So investment demand creates pressure, but it doesn't create the kind of instantaneous supply crunch that snaps a futures exchange in a week. It's more like turning a cargo ship. The ship is turning, but you don't see it happen in one afternoon. Leg 2. Paper market delivery risk. This is where the story got sexy and also where it got sloppy. Yes, registered COMEX inventory was low relative to open interest. Yes, the ratio looked extreme. But open interest is not a line of people holding cash, waiting to take delivery. Open interest is a count of outstanding contracts, and the overwhelming majority of those contracts are hedgers, speculators, spreads, arbitrage positions, and traders who will roll or close their positions long before delivery is even a consideration. Let me use an analogy. Imagine a busy airport. Open interest is like the number of tickets that exist for flights leaving this month. Registered inventory is like the number of seats available on one specific plane type at one specific terminal under one specific set of rules. When you compare those two numbers, you get a ratio that sounds terrifying. But it doesn't mean every ticket holder is trying to board the same plane at the same second. A lot of those ticket holders are going to cancel. Some are going to rebook. Some are just going to let the ticket expire. And that's what happened in the silver market. Delivery notices did increase, but not to apocalyptic levels. And more importantly, the exchange has mechanisms. Eligible inventory, which is metal that meets specs and sits in approved warehouses, can be warranted and moved into the registered category. The system has more flex than the doomsday story acknowledged. Does that mean inventory doesn't matter? Absolutely not. It means you have to watch trends, not snapshots. If registered keeps falling and eligible isn't backfilling, that's stress. If delivery delays are lengthening and refiners are quoting longer lead times, that's stress. But a single week's open interest to registered ratio is not the smoking gun it was sold as. Leg 3. Forced short covering. This was supposed to be the magic. The feedback loop. Price rises, shorts panic, they buy to cover, price rises more shorts panic, rinse and repeat until the system breaks. That's how the story was supposed to end. The problem is the shorts weren't retail day traders with tight stop losses. The shorts were institutions. Banks, market makers, hedgers with deep pockets, access to liquidity, and relationships with clearinghouses that retail traders don't have. When silver hit 121, they didn't panic. They held. They absorbed the mark-to-market losses. They waited for volatility to spike and for weaker hands to start taking profits or hitting margin calls. And when the tide turned on January 30th, those same institutions didn't cover in a panic. They covered methodically on the way down. They bought dips, not rips. And that's why you saw that brutal intraday collapse. It wasn't manipulation in the tinfoil hat sense. It was positioning. It was a market where everyone who wanted to be long was already long. Leverage was maxed out, and the moment momentum cracked, there was nobody left to buy the dip. Now here's the thing that annoyed me most about the squeeze narrative. It treated silver like it exists in a vacuum. Like the only thing that matters is how many ounces are sitting in a COMEX warehouse. But silver doesn't trade in isolation. It trades in a financial system. And in that system, liquidity matters as much as fundamentals, maybe more. When margin requirements get hiked, leveraged longs get forced out whether they want to sell or not. When volatility explodes, risk management models at funds automatically cut exposure. When equities sell off hard, correlations spike and everything falls together regardless of individual supply and demand. And that's exactly what happened in late January. Both the CME and Shanghai raised margin requirements on silver futures. Some reports showed margin hikes happening 3 times in 2 weeks. If you were holding a leveraged position, you either had to post more collateral or get liquidated. A lot of retail traders and smaller funds couldn't post. So they got liquidated, forced selling. And once that starts, it creates a cascade. Stops get hit. Algorithms see the momentum shift and pile on. Market makers widen spreads. And in a thin, volatile market, price can move $30 or $40 in minutes. Let me give you a tell that separated the people who understood market structure from the people who were just riding hopium. Go back and look at who was talking about volatility risk and position sizing versus who was only talking about price targets. The people who understood how this works were saying things like, if silver runs this hard, this fast, expect whipsaw, expect margin hikes, expect violent pullbacks. Keep your position size sane, don't use leverage. The people selling the squeeze were saying, this is it, hold no matter what, we're going to 200, don't sell a single ounce, the shorts are trapped. And guess which group got destroyed when January 30th hit? The ones who confused a plausible scenario with a guaranteed outcome. Markets don't reward certainty. They punish it. They reward the people who can say, here's my thesis, here's what I'll do if I'm right, and here's what I'll do if I'm wrong. So what did we actually learn from all this? Because even though the squeeze didn't break COMEX and silver didn't stay at triple digits, the whole episode taught us a ton about how silver really works in 2026. First lesson: registered inventory matters, but it's not the only thing. Registered metal is metal with a delivery warrant attached. It's immediately deliverable against a futures contract. Eligible metal is metal that meets contract specs and sits in approved vaults but doesn't have a warrant yet. When registered drops, the bulls scream squeeze. But if eligible is sitting there waiting to be warranted, the system has more runway than the headline ratio suggests. During the run-up, we saw eligible metal get warranted and moved into registered as delivery demand rose. The exchange adapted. Does that mean inventory is irrelevant? No. It means you have to watch the flow, not just the stock. If both registered and eligible are falling and delivery delays are spreading, that's a real signal. But if registered falls and eligible is stable or rising, the system has buffer. Second lesson: premiums tell you more than spot price. At the peak in January, spot silver hit 121. But if you wanted to actually buy a Silver Eagle or a Maple Leaf from a dealer, you were paying $130, $135, sometimes $140, depending on where you were. That premium, that gap between paper price and physical price, is one of the most honest signals in the market. It tells you about real-world supply and liquidity at the street level. And here's what's interesting. As spot collapsed back to the 70s and 80s, physical premiums stayed elevated, not as high as the peak, but still well above normal. In some markets, premiums were still $8 to $12 over spot weeks after the crash. What does that tell you? It tells you the physical market didn't collapse the way paper did. It tells you real buyers were still willing to pay up. And it tells you there's a disconnect between the paper market, which is driven by leverage and positioning and volatility, and the physical market, which is driven by actual supply and actual people who want to hold metal. If your thesis is long-term physical accumulation, that disconnect is your friend. It means when paper panics, you get buying opportunities in physical that are closer to paper price than they would be in a normal market. Third lesson: delivery notices are a lagging indicator, not a leading one. A lot of squeeze believers were watching delivery notices like a countdown timer. And yes, notices did climb during the run. But notices tell you what's happening now, not what's about to happen. By the time delivery notices spike, the contracts are already in delivery month. The positioning has already been set. The real leading indicator is what happens in the months before delivery. Are spreads between contract months widening? Is backwardation appearing? Are cash and futures prices diverging in a way that suggests physical tightness? Those are the signals that matter. Delivery notices are the scoreboard, not the game. Fourth lesson: time is still the weapon. You can't speedrun a supply deficit into a price explosion in 2 weeks. Silver supply moves slow. Mines take years to permit and build. Refiners operate on fixed capacity. Recycling responds to price, but not instantly. Even if investment demand doubles, that's a flow that plays out over quarters and years, not days. The squeeze narrative wanted a Hollywood ending, a single dramatic moment where everything breaks. But real markets grind. They build pressure over time. And the people who win are the ones who understand the timeline, not the ones who expect a miracle in a month. Now let's talk about what actually moves silver. Because if the squeeze story was incomplete, we need a better framework. Here's mine. Silver moves on 3 things: liquidity, real rates, and supply chain stress. Not hype, not Reddit, not open interest ratios. Those 3 things. Let me explain each. Liquidity. When the financial system is flush with liquidity, when central banks are easing, when credit is cheap and markets are calm, money flows into risk assets and alternative stores of value. Silver benefits. When liquidity tightens, when central banks hike or drain reserves, when credit spreads widen and volatility spikes, money flows out of everything that isn't cash or treasuries. Silver gets hit. The January 30th collapse happened in part because global liquidity conditions shifted. Reports of tighter credit in parts of Asia, concerns about debt levels, a risk-off move in equities. Silver didn't collapse because the fundamental story changed. It collapsed because the liquidity that was fueling the momentum trade dried up. Real rates. Real rates are nominal interest rates minus inflation. When real rates are negative, meaning inflation is higher than the interest you earn on bonds, hard assets like gold and silver become attractive because they don't lose purchasing power the way cash does. When real rates are positive, meaning you can earn a positive return in real terms by holding bonds, the opportunity cost of holding silver goes up. Right now in early 2026, we're in a weird zone. Inflation has cooled from the peaks of previous years, but it's still above target in most developed economies. Central banks are in a holding pattern. Some are cutting, some are on hold, some are still tightening in regions with persistent inflation. Real rates are hovering near zero or slightly positive depending on which bond and which inflation measure you use. That's not a screaming buy signal for silver, but it's not a reason to dump it either. It's neutral to slightly supportive. If inflation reaccelerates or central banks cut aggressively, real rates go negative and silver gets a tailwind. If disinflation continues and rates stay elevated, silver faces headwinds. Supply chain stress. This is the one the squeeze story actually got right in concept, but wrong in execution. Silver supply is genuinely constrained. About 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. You can't just turn on more silver production by deciding to mine more silver. You have to mine more of the host metal. And those projects take years. Refining capacity is concentrated. A huge percentage of global silver refining happens in China. If China restricts exports, which they've hinted at with rare earths and other critical minerals, that creates a bottleneck. Not at the mine, but at the refinery. And that's what matters for finished product. You can have ore in the ground, but if you can't refine it into bars and coins, it doesn't help the physical market. Industrial demand is real. Solar, EVs, data centers, electronics, all of that is structural and growing. But it's a slow accumulation of pressure, not a single event. The squeeze wanted a spark. The real story is a slow burn. And slow burns eventually do break things, but on a timeline measured in years, not weeks. So here's the framework I use now. If you're buying silver in 2026, ask yourself 3 questions. 1. What's the liquidity environment? Are central banks easing or tightening? Are credit conditions loose or tight? Are markets calm or volatile? 2. What are real rates doing? Can I earn a positive real return holding bonds, or am I losing purchasing power holding cash? 3. Are there visible signs of supply chain stress? Are premiums rising? Are delivery times lengthening? Are refiners or mints reporting capacity issues? If the answers to those 3 questions are supportive, accumulate. If they're mixed, be patient and scale in. If they're all negative, hold what you have and wait. Now let's get practical. What do you actually do if you're holding silver right now in mid-February 2026? First, zoom out. If you bought silver in the low 30s or 40s or 50s, you're still way up even after the January collapse. Silver is trading in the high 70s to low 80s as of this recording. That's still more than double where it was 18 months ago. If you bought at 110 or 115 or 120 chasing the squeeze, you're underwater. And that's painful. But ask yourself why you bought. If you bought because you believed in long-term supply deficits and you were planning to hold for years, then the January crash is noise. If you bought because you thought silver was going to 200 in 3 weeks and you were planning to flip it, then you mistimed a momentum trade and you have a decision to make. Do you average down here? Do you hold and wait? Or do you take the loss and reallocate? There's no right answer that works for everyone. It depends on your time horizon, your risk tolerance, and what else is in your portfolio. Second, if you're thinking about buying now, here's a simple checklist. 1. Decide your maximum allocation to silver first. Write it down. If you're losing sleep over your position size, you're too big. 2. Buy in pieces, not all at once. Silver is volatile. It could go to 90 or back to 70 before it goes higher. If you try to time the exact bottom, you'll probably miss. If you scale in over weeks or months, you smooth out the noise. 3. Focus on physical if your thesis is long-term. If you're worried about system risk or paper market games, own the actual metal. Coins, bars, allocated storage. If you're trading short-term volatility, then ETFs or futures make sense, but understand the risks. 4. Keep your emotions in check. The squeeze crowd got wrecked because they married the position. They turned silver into an identity. When you do that, you stop thinking clearly. You ignore evidence that doesn't fit the story. You hold when you should trim. You add when you should wait. Treat silver like a position, not a religion. Third, watch the signals that matter, not the noise. Stop obsessing over daily open interest reports. Stop refreshing COMEX warehouse data every hour. Instead, watch these. 1. Are premiums on physical products widening or tightening? Widening premiums mean physical is getting harder to source. Tightening premiums mean supply is loosening. 2. What are refiners and mints saying about lead times? If lead times are stretching from 2 weeks to 6 weeks, that's a real signal. If they're steady or shortening, supply is fine. 3. What are industrial buyers doing? Are manufacturers pre-ordering silver to lock in supply? Are they shifting to substitutes because silver is too expensive or hard to get? 4. What's happening in credit markets? Are spreads widening? Are liquidity conditions tightening? If yes, expect volatility in silver regardless of supply and demand fundamentals. Fourth, accept that silver is not going to move in a straight line. The squeeze narrative